Doug at Community Lending Group. And did you hear the news? The Federal Reserve again increased the interest rates by an additional quarter point. Now, what does that mean to you? So for today's mortgage moment, we're going to go through just that. Now, the Feds have been aggressively increasing the Fed fund rate to try to slow down this record high inflation rate. In fact, they've increased the rate by a full 5 percentage points. Now, their increases directly correlates to the interest rate you're paying on your credit cards and also your home equity lines of credit, which is why those have also increased by 5% over the last year. Plus, to make matters worse, the Feds continue to imply that they're not through raising the interest rates yet. Now, this comes at a terrible time because according to the latest consumer debt data from the Federal Reserve, credit card debt has reached its highest total since they began tracking credit card debt. So not only are you dealing with increased food and grocery prices and gas prices, etc., if you carry a balance on your credit card, those payments are skyrocketing as well. So what is the solution? Now, although it's going to vary from person to person, for many, a cash out refinance might be your best option. And many, however, are going to hesitate because they're going to say, boy, the interest rate on my house right now is only 3 to 4%. But to get a clearer picture of your overall debt, you need to look at your blended interest rate, which combines not just the interest that you're paying on your current home, but also your consumer debt and your credit card debt. And as of today, right now, the national average for credit cards is almost 21%. Plus, if you've ran your credit card debts more than 50% of their ceiling, that means your credit score has suffered, and it's possible that you're paying higher than that 21% interest rate, which is the national average. So let's just assume that you have $30,000 worth of credit card and consumer debt. That means that each month you're paying almost $600 a month just to service the interest alone on those payments. That's why having a cash out refinance might make sense, because you can take the equity you've gained in your home over these last couple of years when values went up to pay off some of these higher consumer debts. Now, when I crunch the numbers, it's not uncommon for me to see people's overall monthly debt go down by $300, $500, even $1,000 a month. Does it happen that way for everybody? Absolutely not. But don't you owe it to yourself to at least check some options to see if there's a way you can release some of the stress that you go through every month when you do your bills? I mean, just give me a call and let's run the numbers and see if there's some options for you. You have nothing to lose and you've got a lot to gain. Thanks for watching today, and we'll see you next week.